Hi, this is Zak Mir with a look at some leading indices in the run-up to the non-farm payrolls for February on Friday and in the wake of the Ukraine geopolitical situation, which reached its peak on Monday, the 3rd of March. I'm starting off with my favorite example of the indices at the moment. That's the FTSE 100. Here we have a situation where I presume most in the market are looking for this market to go down. Retail investors are short. I think 75% are short. They had a little bit of a party on Monday with the decline from 6,800 to below 6,700. But as you might expect, with so many punters short, the market bounced back quite quickly. My trend lines have been drawn through the 50-day moving average, currently at 67.06 as the price channel floor from December, and the upper parallel is heading for 7100, which obviously would be record territory for this market. To start Wednesday, we've got the market below 6800, and we have the 10-day moving average at 68.19. My suggestion here really would be to wait on an end of day close above 68.19 as a buy trigger if you are bullish, as I am, or perhaps even 68.60, which would be above January and February, or at January and February resistance so far this year. Only then would you be more confident of a break to the upside over the next few weeks. Otherwise, I can't see the market really heading much below say the 200-day moving average at 76 rather, as the lowest at this stage. We've seen the 200-day line at that level come in as support since the autumn, and I don't think that situation is actually going to change unless there is literally World War III. Moving on to the US markets, and the favorite here probably is the S&P break of the troublesome 1850 resistance zone, and we're now up to the top of last year's price channel at 1900 as the near-term target, only back below really the 10-day moving average at 1847 would really delay the upside scenario there. But the big market, I suppose, the big sort of bullish situation is still the new economy. It's still the Nasdaq, and here we have the composite in the wake of the latest unfilled gap to the upside through the 10-day moving average at 42.89, an implied target here over the course of March as high as 4,500 or even more, which would be the top of the September rising trend channel from last year. The stop loss, quite a convenient one again, would be the 10-day moving average at 42.89, as I've just said. So Nasdaq looks like one to jump on in the wake of the latest very bullish gap here. Further afield, and we have the Nikkei, where I covered this in Spreadbet Magazine just a few days ago for the March edition, and just to reiterate here the bullish situation. What is helpful is the support at the 200-day moving average 14,513 and a rising trend channel in place since May last year. If you're cautious on this market, maybe you'd wait for a weekly close above the 50-day moving average at 15,222. But really, I'm looking for 18,000 at the top of the channel, as you can see by the labels here. And really, that would be a target over the next 1 to 2 months, given the way that this market, once it's consolidated around the 200-day moving average, successfully should start to pick up quite nicely. That's it from me. See you again next time.